All right, welcome back to the podcast. We're here today. With me is co-host Nick Kosko.
How's it going?
And our great producer, Matt Johnson. Matt, thanks for being here with us today.
Absolutely. Looking forward to it.
So, we were thinking of a podcast subject for today's recording and came up with what are some of the basic questions that people have when they hear about infinite banking or they attend one of our events or they attend a webinar. And since Matt has attended one of our business summit meetings in Louisville, he had some great questions that we just thought maybe other people out in the audience, they have the same question. And so we'd like to spend some time running through those questions and answering them.
Yeah. So yeah, it's that was basically the premise. That I've got a few of them that I want to throw at you, and the first thing that really jumped out to me when I was sitting in the audience at the boot camp, the examples are great. The examples from the book are great. I went ahead and read the book on the plane flight in, so I was maybe a little bit more prepared even than the average person would be, like sitting in the audience for that kind of meeting. And one of the things that jumped out to me was when you explain the process of kind of using a whole life contract as a way to build wealth. So let's say you accept the premise that I'm going to take my money that I could be putting into like a self-directed, 401k or something like that, some sort of traditional retirement vehicle, right? And you accept the fact that no, I need to take charge of it. I'm going to break out of the herd. Once you accept that, I sat there and I was thinking, okay, what's in it for the insurance company, right? The idea that your money continues to compound and grow while you still have use and control sounds amazing, right? Which is exactly why we don't get that with 401ks, because it's amazing, right? We don't want that. They don't want us to have that. So the question that I had was, okay, well, insurance companies are no more virtuous than the companies that run the 401ks or the traditional wealth management firms and stuff like that. They're all in it for the same reason. So really, what's in it for the insurance companies? And you had a great answer. I'm curious to see what you have to say.
So yeah, let me just back up and clarify something, because you made a distinction there. You said, how can I build what's the difference between building my wealth through a whole life insurance contract, very specifically designed, or saving for retirement or investing for retirement in a 401k? Mm-hmm. Now, those are two totally different things, because you don't build wealth in a 401k, you build a retirement fund. So you climb this mountain, right? Mm-hmm. And you feel like you get enough in there, and then you descend from the mountain and hope that you don't get to the bottom of the mountain, meaning you run out of money before you die, right? That's what a 401k is designed to do. That is not building wealth, right? Mm-hmm. And it has all these presumptions that I'm not going to retire till I'm 65, or at least after 59 and a half. Well, retire, what the definition of retirement, Nick, is what?
Removed from service.
Right. I'm 53 years old. In 10 years, 20 years, I don't want to be removed from service, but I want to do what I want to do when I want to do it, right? And I want to have fun doing it, and I want to serve other people and teach them how to build true wealth. So let's think of a 35-year-old that has passive income coming in of $500,000 a year, and they say, you know what? I'm financially independent. I can do whatever I want. I'm 35 years old, right? Mm-hmm. That's what we want. We want to build wealth. So we have to make that distinction. The government plan and a qualified plan, whether it's an IRA, 401k, 403b, anything like that, is designed to keep you in the rat race and being part of the retirement crowd, not the wealth crowd. But so going back to the real question that you asked is, why would an insurance company allow people to use this as a bank? Okay, so number one, we got to think of what are the goals of all financial institutions. Okay. What do they want?
4 things.
Right. What are there are 4 things? But Matt, what does a financial institution want?
Well, I would say a bigger financial institution wants to make money, but they want to make it in a very secure way over a very long period of time.
And you know what? The insurance company is right there with you. But the number one thing that they want is they want your money. Mm. Right? A bank wants your money. The insurance company wants your money. How much of it do they want?
All of it.
As much as you'll give them.
Yeah.
Right? And how long do they want to keep it?
For as long as humanly possible.
That's
And
right.
how much of it do they want to give back to you?
As little as humanly possible.
Awesome.
And you answered all those questions exactly right. Okay, so let's just make sure we know that the insurance company is not doing this out of the kindness of their heart.
Right.
Right? The insurance company operates on actuarial science. So they know that if a young guy like you starts to put $100,000 or $50,000 with them, and you're going to do that for the rest of your life, they are going to have this pool of money that they're going to be able to use for 40, 50 or years or more, and that someday they're going to have to pay you out this death benefit, right?
Mm-hmm.
But they get to use your money for a long time. Then when you want to use some of your money, because this is something that a lot of people, including a lot of insurance agents, don't understand, is that when you use your insurance contract as the bank, you're not taking your money out of the account. You're using the insurance company's money.
Mm-hmm.
So the insurance company money is going to charge you an interest-only loan. They're going to charge you interest on that loan. But your money is going to stay and grow tax-free.
Okay.
Now, right now, there are companies that the rates are between 4 and 5 for the companies we use. There's a lot of insurance companies out there that charge up to 8% for these loans.
Okay.
Let's just take 4 or 5%. And it's a guaranteed loan to the insurance company. They have no risk in this loan, Matt, right?
Mm-hmm. Right.
Because your cash is the collateral.
Mm-hmm.
So there's no risk for 4 or 5%.
Mm-hmm.
Pretty good, right? I mean, and in a cash position today, that's a good asset, that loan to the insurance company.
Mm-hmm.
Plus, they have use of your money, right? And you're paying them interest to use money. So why would the insurance company do that? That's why. If there's no free lunch in insurance, there's no free lunch in real estate. You have to, somebody's going to charge you to use their money. And that's okay, because everything that I'm describing is on the left side of the ledger. The way that we would explain it is going to be in the meeting notes. Okay. And people that are watching on YouTube will be able to see this, but is you got to look at the ledger like this. Oops, that's not the right thing. Is you look at the ledger like this. What we're describing is everything on this side of the ledger, inside of the life insurance contract, how the insurance company reacts, etc.
Okay.
Now, remember that we said we're going to use IBC to build wealth. Mm-hmm. Right? That's one of the things that you said in your question, which I really like that you're saying that, because that's the right perception. Okay. So what we're going to do is we're going to take the insurance company's money, and now we're going to move to the right side of the ledger. Okay. Now, for everybody that's familiar with the cash flow quadrant, this would move. You want to move the same direction. You want to move from left to right. Okay. Over here, we're going to buy assets. Let's say it's real estate. Okay. Now, we're going to leverage this real estate 100%.
Okay.
Even if we use a commercial bank. Now, I'm all for seller finance. I'm all for that. The seller might finance it. Maybe we would use the insurance companies for the down payment. There's an infinite number of ways to do it. Yeah. But these dollars, they're going to flow back into the insurance contract, which means they can be that the insurance company's money can be deployed again, because this is going to free up our ability to borrow money from the insurance company over and over and over. And we're going to create velocity of money. But these passive income assets, okay, those are going to be the key. So I get both here, by the way. I get the left side of the ledger, what's everything going on inside the insurance contract, very specifically designed for high cash and cash accumulation. And I get everything on this side of the ledger, which is my behavior. Okay, so now I still want to go back to what the insurance company, the amount of people that take a loan from their insurance contract is very low. Depending on the company, it could be 10%, could be 15%, but that's probably about it. And companies have two ways of recognizing that. One is non-direct recognition, meaning I still get the same dividends and everything else within the company or within my contract, or direct recognition, which means they reduce my dividend or they recognize the loan.
So where they behave more like a bank. They're not quite taking your loan out of the proceeds of your cash value necessarily, but they at least tie your loan directly to an effect on your policy.
Yeah, they're going to say, hey, you were going to get 5.5%, or 5.5% dividend on that part of the dividend calculation, and because you're taking a loan, you're only going to get 4.5. Okay, so now typically, and Nelson Nash would tell you that both types of contracts work, right? Because of our behavior, because of this right side of the ledger.
Right. In other words, what you're doing with it, if you took a loan out against a whole life policy or like that and just burnt the money or something like that, or put it into an asset that really wasn't an asset, it was a liability, that doesn't do much for you to build wealth. If you put it into an asset, that's where you start building wealth.
Right.
Absolutely. And with most people, most people out in that are coaching people on IBC, infinite banking or privatized banking or cash flow banking, whatever you want to call it, they're telling you how to recapture interest that you're paying somebody else. They're telling you how to eliminate lost opportunity cost. We're telling you how to do all those things too, but we're taking it to the next level and we're showing you how to build wealth with it. Right. Or if you're a business owner and you have thousands, hundreds of thousands, or millions of dollars going out in interest and lost opportunity costs, we're really showing you how to redirect the flow back to you with that. I mean, we're kind of
that was one of the
advanced
things I wanted to ask you about, because that's, like if you talk to some of my friends that are doing a combination of, like building investment machines. In other words, they have wholesale machines or they have fix and flip machines, buy and hold machines that, systematized businesses where they have partners who are finding the deals. They have a sales staff who closes them. They have a rehab team. Like they have a machine in place that's investing in real estate, or guys that are out there and they have something similar in the small multifamily and even up into the larger multifamily. What would you tell someone like that? Like what's in it for them to open up their mind to this kind of thing? Like, and what impact are we talking about?
So what I would tell them is, do you use a money pool? And they would say, yeah, we have to use a money pool. It's either our money or the bank's money or a line of credit or something that we have with investors, right? Or use investors' money. Okay. If you could do that inside of a tax shelter, right? And where your money never left and you never interrupted your compounding.
Right.
And you were in control, where you decide loans, if they're good loans or not good loans, where you're 100% in control of the banking function in that equation, would that help you or hinder you?
Yeah, of course it would help. Yeah,
it would help, right? I mean, the whole thing about the bank controlling the banking function is the bank's in control. Whoever controls the money makes the money. So I want to be in control of that. And it allows me to maneuver much faster in the real estate business, whether I'm flipping, whether I'm developing, whether I'm buying real estate for cash flow. It helps me maneuver. And remember in my example up here, as we're getting cash flow, right, from these assets, then what's going to happen is this cash flow is going to come back in, and then it's going to be redeployed to go buy more assets.
Yep.
So I get to create velocity of money with my money and the insurance company's money, and instead of the bank creating velocity of money for the bank's benefit with my doing it with my money.
Yeah. So it's the same process that a bank would do, which is why I call it kind of infinite banking or becoming your own banker. This is the same process they go through. You're just able to take control of the function. And because you have control, then you're the one that makes the profit off of that velocity.
Absolutely. Nick, anything to add to that?
No, I think, part of the natural add-on question to what you asked is like, what's in it for the insurance company and why do they do this, and how is that secured? Well, listen, they're only going to lend you a amount that they can put a lien on your cash value, but also in the inevitable event that you pass away, okay, you got this most likely tax-free distribution of a death benefit that's going to be paid to your estate. But let's just say that was $1 million and you had 100,000 lent out. Well, the insurance company's still going to get paid there because they're just going to pay out 900,000. But in this example, guess what? You still have all of the wealth that you built over there on the right side of the equation.
Yeah.
And it's kind of like the ultimate and asset when you start looking at it like that. It's like, hey, I can look at it scarcely and I can just pile money up in this bag over here and hope, right? Or I can put it to work like the real wealthy are doing. And that's just how I look at it.
Yeah, I agree. And there was something, I think that also goes to one of my other questions that I initially had, because Jim, you talked about the speed, the ability to move faster, the ability to maneuver, the ability to make and then follow through on decisions faster when you're buying those types of assets. I think one of the things that holds, it doesn't hold experienced investors back, but it does hold them up, is going to the banks to get money for a deal. The deal is already in place. The deal is good, right?
Yeah.
But then you have to jump over 17,000 hoops to get the money for the deal that you already know is good. And one of the points that you made about moving faster is the insurance company, when you're taking out a loan against a policy where you're taking a lien against your cash value, the requirements are, we're talking about not next to none, but there's not a lot there. And I think that's one of the other things that I initially found hard to understand. So maybe talk a little bit about why that is. Why don't you have to go through the same type of protection procedures for an insurance company? Is it just the fact that they feel like if you default, there's really no risk there, so they let you kind of borrow their money without a lot of protection against default?
So when you buy an insurance contract, now you have a unilateral contract with the insurance company, meaning you can make changes, but they can't. And one of the privileges in the policy is a loan privilege, right? And because you are borrowing something with no risk and 100% protection for the insurance company, they don't get to ask you what you're going to do with the money. They don't even get to tell you whether you can get the money. It's a contractual right in the insurance policy. Okay, so that's established from the very, very beginning. So you don't ask for a loan like you would at a bank. You order a loan, or you just tell them, send me the money. And, one thing to think about is that you have to, that wealth resides somewhere, right? All your wealth has to reside somewhere. If somebody bought your company or you came into a windfall of $100 million, your biggest challenge is what do I do with it?
Yeah.
I got to put it somewhere. There's not an option of it not being anywhere.
Right.
Right. I mean, it could be under your mattress, right?
Yeah.
But it has to be somewhere. And so when you have money sitting in your checking account or in a mutual fund or something like that, and you want to go buy something else, you want to go buy that real estate that you mentioned, Matt, is you got to decide, am I willing to take the money out of my account and put it in that real estate?
Right.
And if I do that, now it's an or asset. I either have what I had before or I have this new real estate project.
Okay.
In this, you don't. You order the loan, you get to use the insurance company's money to go do the new project, and you keep the asset compounding uninterrupted.
Right.
That's why it's the greatest thing ever, because there's not another place you can do that. And you get 100% of up to 100% of your balance, right? They hold back interest until the anniversary date of the policy, from the date of the loan to the anniversary date of the policy. But I mean, basically you get 100% collateralization. Now, if you had a bond account with a bank, you get about 75 or 80%, a stock market account about 50%.
Okay.
And other assets are going to be discounted because the bank wants to make sure what? If you default, we're good.
Right.
Right. And with this, you're getting 100% use of your money.
Okay.
And every time that you make a payment back in or cash flow comes back in,
Mm-hmm.
You get to do what? Redeploy the money. So
Gotcha.
when you make money, redeploy it, make money, redeploy it, what happens is you start to create velocity of money, and the money starts to move faster and faster and faster.
Yeah, and I think that's one of the things that stuck out to me initially, and I think is hard to wrap your brain around. Maybe easier for the people that are more familiar with the banking industry and how money is really made behind the scenes. But yeah, when you talk about you're going to the next level, it's one thing to take out a loan against your cash policy and go buy your car, and there's value in that, right? Not paying exorbitant interest. Great, that's a win. But it's not the level that we're talking about here. Like that's the most basic level that you can use this at, is just to kind of save yourself from the losses of things like high interest and just being a part of a rigged system. But once you step out of the rigged system, then you can start thinking in terms of, okay, now that I have access to this pool of money, what can I put it into that creates an asset that feeds money back into repaying that policy? So you come out of it with the policy paid back and still have the asset in your hands. Do I understand that right?
Absolutely. So you could take like a farmer with a combine, a $500,000 combine, a dentist with a Cerac machine, or an eye surgeon with a laser of some sort, right?
Okay.
You're talking about could be millions of dollars for that piece of equipment, but that equipment is going to make you money. It's going to cash flow. It's an asset, right? Mm-hmm. It's not a liability. It's an asset. So when you pay $2 million for the equipment, you don't do it so that you're going to lose money. You're going to make money over time. Okay. So when it makes money, then you flow some of that money back into the policy, right? Mm-hmm. To pay off that asset and to do what? Buy more assets. Mm-hmm. or to take advantage of other opportunities. But when we see professionals like a farmer, a doctor, or a surgeon do this, what you have to ask yourself is compared to what? What's the other way to do it? Well, I could pay cash, but then that cash on that $500,000 combine, that's gone forever. Mm-hmm. It never grows.
And all
it never
the potential
earns
compound interest with it.
Right. So I get my $500,000, or I get the combine, which I'm going to make money with. Right. And the reason that I take it out of one account to go buy it and use it for the combine is that I'm going to hope and know that the combine is going to make more money than what that account was going to make.
Yeah.
Right. Mm-hmm. Or I go borrow it, and the insurance or the bank gives me a loan, and then I'm going to pay interest, and I'm going to pay probably volume of interest. Maybe that $500,000 combine is going to cost me $700,000 or $800,000, right? Yeah. And I hope that the combine makes enough money to make all that make sense.
Yeah.
Right.
Yeah. So Matt, think about that. Oh, I'm sorry, Jim.
No, go ahead.
Think about this too, Matt. That combine you spend $500,000 on. Let's say that thing you're able to produce $100,000 with that in a given year. Okay?
Right.
And you take, compared to what, you take that $100,000, you put that into your brick and mortar account. Well, they give you $100,000, right? Well, with the way that the life insurance contract works, with the guarantee growth inside of it, let's say that I take that $100,000 and I put that into my life insurance contract. And after a few years, due to the compounding nature of it, I put in the $100,000 and I get $200,000 to use. Mm-hmm. So I'm comparing that to the brick and mortar. And I love that Jim asks that all the time. Okay, that just compare it to something else. Right. And most people aren't doing that. They'll compare it with their mattress money compared to the checking account. But what they don't realize is that there are massive amounts of money that are being used through contracts like this. And it's incredibly powerful when you don't interrupt the compounding of taking that $500,000 out. Mm-hmm. It stays in the contract. It's still growing for you. And as you feed it, it can multiply on itself.
Yeah. And it's self-completing, meaning that if you, God forbid, you were hit by a truck within the first year, the 10th year, or the 50th year, your family, your beneficiaries are going to get a tax-free benefit. Mm-hmm. Now, the thing you got to think about is tax-free death benefit. Also, there's some protections in there for terminal, critical, chronic care.
Okay.
And so there's a lot of different uses for these policies. And how many things in your life can you say that I'm going to use all the cash if I need it for my care when I get older? And then eventually when I die, people that I love and care about that I leave behind are going to benefit from it too.
Right.
Now, we have to think, and again, the people that we're working with, a lot of times they've made a lot of money, they're very successful, and they're looking for a way to make an impact.
Mm-hmm.
Where's the first place you make an impact?
Yeah.
With the people that you love.
Yeah.
Right? Then it's the causes, and this is unlimited. This as you build your banking system, it's okay, my charity that I care about the most is going to get this. My family's going to get this. And you start to build this legacy. And this is what wealthy families have done forever. This is what they've done. The smart ones, the ones that still have money. Okay? Not the ones that blew it all.
If we're going to go through, if we're going to do what it takes to build the wealth, let's do what it takes to keep it and pass it on to the people that we care about. So,
absolutely.
Well, let's wrap up there because we could go deeper down the rabbit hole. But those are the main questions that I had for this particular episode. We'll do maybe one of these down the road where we talk about some other questions that I and other common questions related to the content. But let's finish up here, Jim. What's the best way for people to reach out and connect and learn more?
The easiest way is to go to createtailwind.com, and there's a spot you can enter your email and request an overview. Now, this overview is normally done electronically. It'd be like on a webinar just like this. Mm-hmm. So, nobody's going to throw you down on the ground and twist your arm behind your back. I mean, you're either going to like this or you're not. We
sleep the same either way.
That's right. Yeah, our heart rate does not increase or decrease depending on whether you wanted to start a bank, not start a bank, put $10,000 a year in, or put $10 million a year in. Mm-hmm. It's just the way that we do business is our heart rate is not going to change one way or the other. We are going to show you this. We're going to educate you. And if you decide you want to move forward, great. But the best way is to do that, Matt, because in 45 minutes to an hour of seeing this, mm-hmm. you'll know, hey, this is for me or it's not for me.
Yeah.
Agreed. Yeah, and if you're a regular listener to the podcast, and you're already of the mind that you want to break away and build wealth in kind of unconventional alternative ways, then that kind of speeds the process up a little bit. You have some common ground to agree on. Like definitely, I came to the table with that mentality already. So as long as you come off the podcast, you're already going to be prepped for some of the concepts that you'll learn. So love that. Nick, thank you so much. I know you didn't get a chance to pipe in very much because we wanted to shine the spotlight on Jim on this particular one, but gentlemen, I appreciate your time.
Yeah,
thank you. Thank you. Take care.